This is a video as part of the continuing series on the valuation formula that discusses the specific inputs. Input being discussed in this video is the competitive advantage period, often referred to as Y in the formula, but it's the period which you feel that a company has some unique competitive advantage, and usually that's set to 5 years, and then after 5 years you assume that the company mean reverts to more of an industry standard level of return on its projects. What we're showing on the screen is Netflix, and we'll be using Netflix throughout this video as an example of the kind of company where you may want to modify the default value of Y to something like 7 years as opposed to the default of 5 years. Now, the reason Polaris uses 5 years is that many academic studies have been done around competitive advantage, and studies show that in capitalism, competitive advantage erodes quickly. As soon as 18 months, 5 years, and definitely by 7 or 8 years, the success of a company quickly gets copied. And really nothing causes mean reversion like success. Now, there are exceptions, particularly in like high-tech companies. They have some unique kind of first mover position in the marketplace. There could be other examples of some kind of government regulation that prevents competitors from quickly moving into a space. There could be patents, things like that, but those kind of situations tend to be rare, and that's what this video is kind of about, is those kind of companies where you feel like that the first couple of years here of competitive advantage may be extended beyond just 5 years. So when you're looking for these kind of companies, first thing you want to look at it when you go look at a company on the Polaris website is whether the operations type is dynamic or stable. Now, companies that you want to extend the competitive advantage period for don't necessarily have to come from dynamic, but that's typically where you find them, where companies their operations are going through a lot of change, and that change usually represents some really unique situations that may take longer to play out than just 5 years. An example on the other side where you could have might make sense to extend the competitive advantage period out would be a company like Microsoft. It's considered to be stable by Polaris, but it's going through some resurgence here as of late, and particularly in the cloud space with its Azure offering. And it may take years for that to play out, more than just 5 years. So it's not exclusively dynamic companies, but more often than not, that's where you'll find the need. If you're going to modify this Y period or competitive advantage period, it's usually involved with more often with a dynamic company. So for most companies, 5 years is sufficient. Now, on occasion, you may want to take it up to 10 years. You may want to go the other way. There may be a situation where you feel like the competitive advantage period will erode extremely quickly, and it may want to lower it. But I can't even think of an example of like a stock like that. Maybe a Blockbuster years ago, where selling videos, renting videos, this wasn't that unique of a proposition, and that advantage eroded very quickly. When you talk about extending the period, usually you're dealing with companies that have enormous sales growth, and you just feel like that sales growth will continue on. Well, when you have companies with really high sales growth, you get into kind of an odd situation where you're here in this first period, shown in this graph here, where you're assuming some very high initial growth, and then so many years out, default is 5. You assume that the mean reverts to a more industry standard sales growth. Well, with high growth, that's conceptually a little hard to fathom, because if you're up here at 45% sales growth, and then conceptually you're thinking that, well, then in 5 years it just drops down to here's an industry standard of 9%. So 45% growth, 5 years down to 9%. Well, now if you extend out to 7 years, 10 years, now same thing, very high growth, and just all of a sudden down to normal growth. Well, that conceptually is not real logical. So a different way to look at these kind of companies is to think that the sales growth you actually specify with the slider is more of an average sales growth that you expect over the period, and that really what you expect to happen is some high growth to occur, extremely high growth to occur in the early going, and then it'll gradually come down and then meet up with the industry standard 7-10 years out. Like there's a famous model, investment model out there called the H model that was created back in 1984. It goes into a lot of detail, so I'd suggest if you're interested in learning more about this, that you go out and search for the paper that describes this. But it basically just boils down to taking an average between the high growth you expect at the beginning and then the industry standard growth that you think it'll mean revert to, and you just take it, divide by 2, and that's the average that you built into your model. Now what I like to do with really high growth companies is, because the mean reverted growth by comparison is so small that it's almost think of it as almost being 0. So what you're really doing is you're saying, okay, my average growth, in this case 45%, really implies I assume a 90% growth initially, and then it's going to come down to the industry standard 9% growth 7-10 years out. So again, when you're dealing with high growth companies, where particularly when you're extending the period from 5 years out or even longer, it just conceptually this mental model of just a sudden drop just doesn't make sense. So it's best to mentally think that what you're doing is more defining an average, which again expect the start of the starting period will have twice that growth, and then by the time you get to the mean reverted period, you're back to the industry growth. All right, so we're looking at Netflix, and let's say you've got you're thinking that really the sales growth of 45%, maybe you think that's appropriate, but you think it's just going to go on more than just 5 years. So you want to extend out to 7 years. Well, let's go look at the formula that's used by Polaris. And for these kind of situations with such high growth, you can really think of the first period where you assume that dividends are being paid. In the case of Tesla, there are no dividends, so it makes it even more true that for a company that pays no dividends. So you can just ignore this for part of the formula, and just focus on the second part of the formula. And you'll notice here that when you the formula has Y, or this competitive advantage period, in 3 places. One is the
gross sales.
In this case, 45% for 7 years versus 5. You've also got a future shares that's computed by taking current shares and multiplied by some shares growth over the next 7 years as opposed to 5. And then you discount it all back using a cost of capital for 7 years instead of 5 years. So it shows up in 3 places, and if you do some algebraic manipulation, you'll determine that to modify
the competitive advantage period,
you just have to account for a change in valuation that's shown here. So I'm going to go ahead and calculate that for Netflix. I'm going to assume a 45% sales growth, share growth of just about 1.4% a year. Cost of capital is 7%. Now where I got the 7% is from here, and then when I scroll down, I can see that the growth of shares is assumed to be 1.4%. When I plug those into the formula to determine what the impact would be on valuation, and by the way, I'm going to use an exponent of 7 years as the user expected number of years versus the default is 5, so that's a difference of 2. So we'll multiply or calculate that factor there, I end up with 1.8 roughly is the increase in valuation. And it ends up with a new valuation of $370. So I'm going to come here and I'm just going to move the slider till I see something around 370. So there I get 372, and then it shows, you know, a growth of 63%. But again, the growth I'm really assuming is 45% in sales growth, and I've just modified the sales growth slider to account for my opinion that this growth will continue on for 7 years. Well, you notice here the practical valuation is equal to the theoretical valuation, and you might assume that the practical investment return now is 8.2%. Well, that's incorrect, because when we go look at the formula that's used to determine this IR, or this investor's rate of return, is that you take the current price, in this case it's $352 roughly, and you assume some growth for 7 years now, and then the valuation, present value, is 372, and you assume that's going to grow at the cost of capital of 7% for 7 years. The default calculation assumes y is 5, and even though the valuation is done in such a way by moving the sell slider that you get an increased valuation with the assumption of 7 years, it just doesn't cancel out when you bring it into this calculation. The y doesn't, so you just have to recalculate what the investment return would be under this scenario of extending out for 7 years. Well, when I plug in the valuation, the price, 1/7, and then multiply it by 1.07, I get it 1.05, or a 5% practical investment return. Well, when I go to save this off into my plan, if I just click Add Plan, it's just going to take the 8.2% and make that my target rate of return going forward. But as we just calculated, that's not correct. It should be 5. So now you just move the slider back down till you get something, you know, you're not going to be able to hit it exactly, but get something around, in this case you have to pick between 4.3 and 6.2. I'm going to go ahead and go with this target rate of return, investment return of 6.2. So now when I add it to my plan, I go over here and look at my investment plans, and there's Netflix, 6.2%, and now these thresholds that have been calculated are based on that target return. It takes the current price, and then it says, okay, the current price is roughly 352, so if it drops down to 321 or goes up to 392, if it stays within that range, it's saying that let's go ahead and buy. And as we've talked before on other videos, we know that what we just are looking at really is this purple line, and the range around any time around the purple line will continue to change as time moves on. Now it's important to know that these thresholds that are being shown in the investment plans assume 5 years. So if you were to let the plan run 6 years, 7 years, you would actually be extending the purple line above this red dot, and it would continue to grow. But that's likely not going to happen, because most investment plans you let run for at most a couple of years. Things change with the stock, and requires you to go back and rethink your plan. So most people will update their plans way before the 5-year mark. So this phenomenon I'm talking about, when you extend the period, the thresholds really continue, growing well past 5 years into 7 years and beyond. Typically, you would have a new plan well before that, so it's not a major concern. Well, in summary, when you look at extending the competitive advantage period, or Y, it's really very unique situations. Most times you should focus on the primary inputs into the model, which is sales growth, the sliders provided for that, and then profit margin would be the other value most often if you're going to modify anything or modify the sales growth to account for a different profit margin. So think of why is just you got to really think it through as to why you would be modifying why, and really the Netflix's, Tesla, and just a few handful of stocks that would even make sense to do this. Thanks for watching.